Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 23rd of April. I'm Daniel Lam, your host for the podcast. Last week, I did a three-part series of podcasts regarding the return of volatility in risky assets. Since then, we have seen some headline-making retracement in the U.S. growth stocks, and this was a key point made in that series. Now, today, let us dig deeper as to how this may play out in the near future. We have been talking about the first quarter 24 earnings season being a key source of risk because the expectations were a little bit too lofty. Now recall that back in January this year, the beats from the key semiconductor stocks globally served as a catalyst that led to major rally in large-cap growth stocks for January and February. But it seems to be the exact opposite this time around. Yes, the broadening of the rally in U.S. equities would help to soothe the volatility in the growth space. And this is one of the key reasons why we like to diversify into the U.S. energy sector. However, the shoes of the mega cap growth stocks are quite big to fill. So there's a significant impact on U.S. equity positioning and flow dynamics when these stocks pull back, because much of the equity buying activity among CTAs and retail investors this year occurred immediately following the start of the last earnings season. So these have turned sharply because CTAs were strong sellers of equity products last week, and this trend appears to be continuing. The break in the minor support levels in the S&P 500 index has also caused trading models to have a selling bias for U.S. equity securities. Now, what about retail investors? Can they be the bidders? Well, there has been a lack of individual investor participation, judging from the relatively quiet activities at the U.S. cash markets open, a period which has historically seen heavier retail activities. And historically, there has been weak seasonal demand in retail buying in the month of May. So, what should investors do now? Well, like we said last week, there is likely to be further room for U.S. equities to pull back. Now, a simple look at the technical chart shows 4,700 for S&P 500 index as a key support level, followed by 4350. Now, in terms of positioning, there were 7 occasions since 2010 when the U.S. equity positioning crossed the plus 1.75 standard deviation threshold. Now, on average, U.S. equities would pull back by 5% in the ensuing 3 months. Well, this is the 8th time. And that would also indicate a pullback to roughly around that 4,700-ish level as well. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.